Good morning, everyone, and welcome to the 6th monthly webinar for the Pengana Emerging Companies Fund. Thank you for taking the time out of your busy schedule to join us today. My name is Ryan Crew, and I'm in the Pengana Sales and Marketing team. Today, I'm joined by Ed Prendergast, the co-portfolio manager for the strategy, who will be providing an update on the fund, which, given the continued market gyrations, is quite timely. Just in terms of some housekeeping, Ed will speak for around 25 minutes, go through the presentation deck, and then he will be available to answer any questions you may have after the session. You can submit questions online via the portal throughout the webinar, and we'll do our best to address them at the end. So without further ado, I'll pass along to Ed now.
Thanks, Ryan. And thank you, everyone who's on the line, for your interest. As Ryan said, just shoot through any questions as you on anything, whether it be stocks we own or the market in general, and we'll do our best to come back to to those at the end. So I'll give you, just by way of the slides, if we go to slide 2 briefly. This is just a backdrop. I think I'm going to assume that most of the people that are on the line have had some history with us, and so they know the basics of how we run the fund. I guess this is just a reminder to say that we're in our 15th year now. Steve and I are running this fund, and nothing's changed. So it's the same two individuals that are making all the decisions, doing all the research and the modelling, and nothing has changed there. We're still co-owners of the business and heavily invested in the fund directly, personally. So we'll go now to slide 3. And this is a bit of an update, just a summary, which we'll flesh out in more detail as we chat further. Just starting from the left-hand side, over the last 12 months, the fund, in a pretty weird market, frankly, is up about 1%. And I can give you an update on the April numbers as we go into the presentation. Now, being up 1% in a market that's up 6% is a little bit disappointing for us. It's a shorter time frame. We don't want to. We're not. It's not that bad, but equally, it has been quite a strange market, and I'll give some context around that. We paid a large distribution in June last year in order to trim back the size of the fund, which we don't think we are as desperately keen to do right now. The fund size is about okay. And you can see there in the top performers and the bottom performers, when you look at some of those stock price moves, things like Jumbo Interactive up 240%, and Pro Medicus and Clover, Charter Hall even up 75%, and then a few other stocks which haven't worked. You can see that's indicative of the level of volatility we've seen at the stock level over the last 12 months. And you guys, anyone who's on the call, obviously is aware of markets and what's been happening over the last year. And then the other key number I would bring out is can I just double check I'm still on the line? I pushed a button or I heard a beep.
Yes, you are, Ed.
Oh, good. Sorry about that. So the company meeting, so we've met 253 companies over the last 12 months. That's more than one a day, and that's really what we spend most of our time doing because we're not particularly active traders. Slide 4 is the context for performance. A busy table, but I'll make it easy. On the right-hand side, that's the very long-term numbers. So over 14 and a half years, we've delivered 13% per annum after all fees, which is well in excess of the market. The 10-year number, by coincidence, is roughly since the GFC, or the lows of the GFC, and you can see the numbers there have been pretty consistent, pretty strong. And then as we move towards the 1 year and 3 month numbers, you can see that the 1 year numbers I've already sort of mentioned is in the context of a pretty weird market, little bit flat for our liking. And over the last 3 months, the fund was up 10% in the 3 months to March, and equally, so we've got one more day of trading in April, and the fund is up about 5.5% in April, which is obviously a good month, and that's ahead of the market. So we're reasonably pleased with that. And then if we go to slide 5. We just sort of flesh out a few themes that have driven markets and our performance over the last 12 months. I don't need to tell anyone how volatile the markets have been. The September quarter was phenomenally strong. December quarter, the worst in 11 years. The March quarter, almost vertical bounce. all on the back of flip-flopping by the Fed. But anyway, these are forces well beyond our control. But what they do is create enormous volatility at the stock level. And we mentioned also the small cap sector changing. It's probably an overstatement. It's not necessarily changing, but it has actually had a lot of volatility in the sense of the market participants over the last 9 months. A lot of industry funds have bought their investments in-house, which means where they used to use a fund manager, they might bring $200 or $300 million back in-house, and that means that those stocks actually have to be sold, and they're often sold without any care at all for price. Because they're sold by transition brokers, and we have had a lot of that going over the last few months. And what that means is that share prices can fall 20% for no reason whatsoever, and it's just two sellers that in a volatile market are trying to get out at the same time. The tech stocks have been phenomenally strong globally, and in Australia, we're starting to actually become famous for how strong our tech stocks are. And what I mean by that is that there are now American companies, smallish American companies that are in the fintech space that are listing in Australia rather than listing in America, and it's because they think they can get better valuations here. That's a bit of a red flag for me, but anyway, this feels a little bit like the tech boom, and it's not the sort of, given a lot of these stocks are now trading on valuations which no one can really justify. It's just a gut feel that they're going up, so you've got to buy some. Those sorts of things to us are really, they make us nervous. They're not the sort of stocks we would heavily invest in. And I'll run through a couple that we have invested in, so we haven't missed out entirely, but we are reasonably sober investors and happy to, when valuations are stretched, we're happy to have sold and missed the last run in the share price, if at all, because when these things turn, they turn quickly. Don't get much warning. When we talk about regulatory risk, this is something that has impacted us through our holdings in Macmillan Shakespeare and Smart Group. They're two large holdings. They are in salary packaging and novated leasing, and to a certain extent, their reason for existing relies heavily on the fringe benefits tax legislation and also the commissions they earn on novated leasing and insurance when they sell a car. Now, the Royal Commission, when Hayne came out, one thing which I've got to be careful how hard I go here, but I'm not sure there were 74 recommendations. One of them was pretty bad, and it's since everyone in the markets and in fact both sides of politics have said it was a bad recommendation. That was banning mortgage broker commissions. And what that meant, we didn't own any stocks that were exposed at all, but what it meant is that the markets, there's a sense that, oh, hang on, if that can happen, what else can happen? Are all commissions banned? Is the insurance company industry going to be shut down? Is the novated lease industry going to be shut down? And there's no time for thought. There's no time for proper analysis. It's just sell now and worry about it later. And so therefore, Macmillan Shakespeare and Smart Group have actually fallen about 30%, which has impacted us. Now we have, because of that political uncertainty, we have sold some because we think that the risks are slightly higher, but we also think right now in the pricing it's well overplayed. There's been plenty of takeovers in small caps, which we have missed out on, frankly, that have lifted the index, and we have had a couple of what I would call mistakes, and we make mistakes every year. We're trying to get sort of 6 or 7 right out of 10. A couple of them worth noting are Access Today, which is a small asset finance business, which through a change in the accounting standards actually has needed to raise capital and hasn't been able to because the markets have been too volatile. It was a very small investment of ours, which we have actually written down to zero. Now, that's something, if they can raise capital, then we will get that back, but we are unable to support a valuation. That didn't make much of an impact. It was about 0.5% of the fund, but Bingo was a negative for us. We did own it and sold it straight away when the profit warning came out, and have moved on. So I guess the key, and the mining services stocks, frankly, have been all over the shop, but we don't see any change in the underlying dynamics for our smallish holding in that sector. And I guess the key reminder is nothing's changed from our point of view. It's just that these markets have been reasonably challenging. Slide 6 just shows you the longer-term performance of the fund from inception, with all the dividends reinvested. So we'll leave that for people to dwell on. Slide 7 is a quick reminder that we will always, from day one when we establish the fund, we'll always try and keep the fund at a small or manageable level of size of FUM. And you can see as you move towards the right-hand side, that's us giving money back. And as I mentioned earlier, at the moment we're about right, but we will give it back if the fund grows much from here. Slide 8 is a bit of a sort of a talking point, I guess, as to sort of some of the macro events. And now keep in mind, we're not a macro fund. We are fully invested at all times, so we never make a call on what we think the market will do. We think that's particularly dangerous, given that that's what an asset allocator is paid to do, not us. So when we talk about the overall market, it doesn't derive how we invest, but there are obviously macro themes there that whether it's Trump's Twitter account or the Fed that seems too scared now to taper. Inflation has almost disappeared, and it's remarkable how quickly inflation fear went to deflation fear in 3 months and drove markets much higher. And so domestically, declining house prices is having a wealth effect, and you're seeing that in a lot of the retailers are seeing subdued conditions. We have avoided that. The Royal Commission has really opened up regulatory risk, and we've mentioned that. And then the one sort of glimmer of reasonably strong activity and outlook in the Australian economy, because housing's tipping over and retail's pretty soft, and therefore media and those sorts of areas are also soft. The mining and infrastructure side of things, so anyone who's involved in providing labour or services to the non-residential construction industries is very well positioned, and simply you can see all the budget comments, Fed and state, are all spending up on infrastructure. At the same time, the mining companies are starting to respend. So we'll skip forward for a quick comment on slide 11. What this shows is, so we were mentioning before where the tech stocks have gone absolutely bananas over the last 2 years. So Afterpay, for example, is up 700%. Appen is up 550%. It has been phenomenal, and they now trade on PEs of in the hundreds. Now that, in layman's terms, that's a valuation that no one can fully justify and hold their hand on the heart and say it's actually worth that. It's nosebleed stuff, and it's not to say they won't keep going up, because momentum's a wonderful thing, and so's optimism, but it may or may not last, and we have to have very strict valuation parameters. So on those stocks, I know it's a busy chart, but the blue line at the very bottom on the right-hand side shows you that the small ordinaries over the last 2 years has risen 22%. And the worst in inverted commas of these tech stocks, which we do actually own, was only up 63%. That's the next bar up. And so as you go up that scale, you see that these stocks have performed phenomenally well. Now, we do own Pro Medicus and Altium, which I'll come back to. They're two businesses that are sensational Australian tech stocks. But things like Afterpay, where you're starting to capitalise, the stock today is being capitalised at $5 billion on a P of 120 times. Moving into a market in America with this buy now, pay later service. Now, they're the first to the market. The regulators haven't even looked at it yet. Who knows what the regulators might decide when everything calms down, and that could actually be a particularly rocky road. Or it could continue to grow phenomenally. It's just our risk profile shows that on those valuations we're not going to participate particularly aggressively. If we mention, slide 12 is just a quick reminder of our pretty decent holding that we've got in the investment platform operators, namely Hub24 and Netwealth. It's about 5 or 6% of our fund. Now, for us, it's one of the great market share switches that we'll see. You don't see industries change this often. The last time it happened was when Telstra was the monopoly, and when that opened up, all the little telcos were able to chew away and just build from a percent market share to 2 to 3 to 4 to 5, grow phenomenally high rates. So people like TPG and M2 and Vocus, and because the market was so big and you had it dominated by one player. That's how we see this playing out, hopefully. It certainly is at the moment, and that is that 80% of the funds on platforms in Australia are on the large five, meaning AMP and the banks, and they're losing market share very, very quickly, and it's because the new platforms have no conflict. They have better technology. The pricing is reasonably competitive without being too heavily discounted, and their service culture is much better than most of the bank operators. So if you look at slide 13, this shows you that that where all the funds are. So they're on the left. That's where the great and I think there's $800 billion of funds on platforms. So Hub and Netwealth have I'll go reverse. Netwealth and Hub have 2 and 1% market share. So can that 2 and 1 become 10 and 5 or 20 and 10? Who knows? But the next slide, slide 14, shows you what's actually happening. And this is the share of net flows. So as the industry grows, as it does with the superannuation guarantee levy, you can see now that the brown bar is the old platforms, the other 3 lines are the new platforms, and you can see now where a decent share of it used to go to the old platforms. Look what's happened in the last two or three trading periods where the money is flowing at a phenomenal rate. And the Royal Commission has really flushed out conflict and also removed grandfathering of commissions, which was a driver to keep a lot of funds sitting on old platforms because there were commissions going to the advisors. So but having said that, I guess with the platform business, it's not without risk. It's an evolving industry. The stocks have priced in a fair bit of upside now, not all of it, we think. Now, the reason I say that is if we thought they were riskless and that opportunity was that big, we would have 15% of our fund in it. We don't. It will be volatile. It'll be a rocky road. Therefore, while we love it, we're not going to bet too much of the farm on it. I'll run through a couple of our holdings in the tech sector. I mentioned that before. So slide 16 is, again, with the tech stocks, so our holdings have been in Technology One, Altium and Pro Medicus, all of which have done very, very well. But our holdings are pretty small because these are not without risk. Things can change in technology. But anyway, I'm happy to run through these couple. So Altium, which is about 1% of our fund, has done very, very well. They sell software that people who design printed circuit boards use as their platform. So it's like a CAD-based system that you design a printed circuit board for a fridge or a TV or whatever it might be, or within cars. These guys are the leaders globally. It's Australian technology, huge market, and they've been growing revenue at 20% plus. And then the big driver from here will be the extent to which machines start to actually talk to machines. And what I mean by that is your phone will talk to your fridge, and your security system will be internet based. So all of that involves printed circuit boards. So there's an acceleration of demand. Very solid management team. Valuations are pretty full, frankly, if you look at short-term numbers, but that's what the valuations looks full at $5. It's now at $35. These stocks typically do look, if you just look at short-term, they do look expensive. Pro Medicus on slide 17 is a Melbourne-based business that has invented software that efficiently transfers X-ray and MRI files from over the internet from one site to another. And the reason, so they're huge files. If you can imagine, it's very hard to compress a file and send it from, San Diego to LA, where the brain expert is and who needs to look at this file. So Pro Medicus' product is the world leader. It's been winning almost every tender in the US for the last 5 years. We've owned this for quite a few years. The CEO and founder, 30% of the company, and it's they've now landed the largest imaging group in the US. They've landed the Mayo Clinic. They've got about 5% of the market. So, and the global competitors are monstrous international players like Kodak and BASF, who have not got the technology to match. So, it's all recurring revenue, and we think that can continue to grow very strongly with only 5% market share. The next two slides are slide 18 and 19. It's just a quick comment. We're recapping here, but Macmillan, Shakespeare and Smart Group have not performed very well of late. They've been great investments over the last 5 years, but the last six months has been pretty dismal just based on that regulatory risk, which we mentioned. Slide 20 is a stock that's now in our top 10 holdings and Equity Trustees, which is a sort of a diversified financial services player. They do a lot of financial advice, so financial planning, estate planning, those sorts of things. They advise philanthropic organisations and and do the trustee services for superannuation funds and responsible entity for fund managers. It's pretty well diversified, and it's not, frankly, we've known this company for years. It's not a business that had really shown much growth. New CEO joined roughly 2 years ago, and so they've started to invigorate a bit more of a sales culture in the business, and also the Royal Commission has put a lot of pressure on the industry in general to show separation, or remove any perceived conflict within financial services operators. And I'll give you an example. A large super fund, which has an internal trustee, there is a sense after the Royal Commission that is not the thing to do. You need to separate the functions and outsource your trustee. And the boards of these trustees are all, you can imagine, they're pretty nervous. There's a lot of names that have been dragged through the mud in the press. Therefore, this outsourcing trend, which has only just started, plays directly into the hands of equity trustees, which is the biggest player in superannuation trustee services. And then two others, quick ones. Slide 21 is a bit of a reminder of one of our biggest holdings, Mainfreight. It's a New Zealand-based company that's been in our top 5 holdings for probably 10 years. It has done very, very well. It's a very well-managed logistics business. There's nothing particularly exciting. It's sort of, I guess we like to put this in because it's a reminder that good management is absolutely key in these businesses. Their ability to control growth and to drive growth is important. Even in stocks which on paper don't look that exciting, and take it from us, we've had plenty of meetings with management. We're very, very comfortable that they know what they're doing. And Lifestyle Communities on slide 22 is the last one which is worth mentioning. Again, very, very switched on management. The founders are still heavily involved and heavily invested in the company. They do retirement villages in Victoria in the poorer or the lower end of the market, the very low end of the market. So these are areas that most property developers can't make money developing retirement villages in. And Lifestyle Communities, they started with one village, and they only sell the unit. They don't sell the land, so it's very, very affordable. They're selling to people who, when they sell their house, they're selling them for sort of $350,000 or $400,000. So again, just a reminder that it's not the top end of the market. And growing demand on the basis of the population changing, and equally now, as I mentioned, they started with one village. They've now moved to, I think they're on their 11th or 12th, and there's a sense that they can do 2 more a year well into the medium term. And if you think about it, once they've built it and sold the units up front, then they have a rent roll. So it's a great recurring revenue business. It's not particularly, and equally the share price has been hit recently because there's a sense that the property market is bad for all retirement village operators, which is a general rule that it's reasonably true. It's just that these guys operate in the end of the market that's already struggling. They're not in the boom market, which would be more of a worry. So then, and slide 23 has our top 10 holdings. I think I'll leave it there and just hand it over for questions if there are any.
Great, thank you, Ed. I've got a couple questions which have come through. I'll just read them out. So, Ed, what is your view on small cap companies that trade in commodities over the short to medium term?
So commodities trading stocks, we this is a quick reminder, we don't invest in resources stocks at all, and the major reason is because they live and die by the direction of the commodity price, not by by management skills or industry structure or things like that. So stocks that trade commodities, we would put in the same basket, and so we will never have a view on where the gold price is going or where the copper price is going. It's the sort of risk that we see is too high. So unfortunately, it just doesn't apply to us, that one.
Okay, great. Next one. How have companies on your radar, both in the portfolio and outside, been affected by the volatility over the past 6 months?
Well, it's probably going back to a lot of the comments I made at the start. Extraordinary volatility at the stock level. Some of it has been justified in that, for example, you might have a sort of, with Macmillan Shakespeare and Smart Group, you might have a sense of heightened regulatory risk. Some of it has been literally just caught up in massive swings in global sentiment. So if I give you a quick example, the mining services stocks were very strong in September quarter last year, and then Seven Group which is the biggest kind. It's like the bellwether of that sector. It owns Westtrac, which is the Caterpillar engine business, and Coates Hire. So in the December quarter, that stock fell by 45%. So it almost halved in one quarter, and nothing about the commodity markets in Australia changed at all. But there was a sense that you just sell anything that's cyclical, and this was a global thing. And when you get volatility like that, people aren't slowing down and crunching numbers and gently and discreetly deciding on investments. It's just driven on massive amounts of flow and panic and volatility. So a lot of those sorts of stocks, and then they've bounced very strongly since. But there's been a hell of a lot of that at the individual stock level. And then if you overlay what's happened with the industry funds moving away or bringing some money in-house, that has added to the volatility.
Okay, great. You did address this one a little bit, but I'll just put it through to you anyway. What is your view on buy now, pay later stocks, such as Afterpay and Split It?
So the sector, the business itself. So we've done a lot of work on Afterpay. I don't mind the product. I think it's really cut through to a demographic that is it resonates very well. So and I think it can continue to grow, and it can definitely take a decent share of the US market. But our query on that stock and Zip Money and a few of the others is not so much is the business justified. It's just that right now you're paying multiples of, you're paying enormous multiples, which means you've got to be guaranteed this thing grows at 50 to 100% for another 5 years in order to for it to make you money. And in the meantime, growth rates can be volatile, and more importantly, regulators haven't even opened the file on this. So I'd imagine that, because remember when Afterpay went into the US, they were the first in the market, which is amazing. Just shows you the market didn't exist. Regulators will open the file at some point, and there could be announcements that you won't see coming, and the valuations are, you'd be nervous if you ignored regulatory risk altogether.
Fantastic. On that note, another one's come through on the portal. So, Ed, on the tech stocks that you hold, how do you arrive at a fair value?
So with Altium and Pro Medicus, we look at. So I'll take Pro Medicus for example. We keep a small weight in the portfolio, and that's because coming up with a very strong, distinct valuation is hard in a company that's growing at 100% per annum. So then what we would do is we look at the addressable market. We keep in contact with the company as much as we can, but which we do, but then we look at the size of the addressable market and the trends and say, well, look, they've been growing at 100% for the last few years. They have 5% of the market. If they can get to 20 or 30 or 40, what does that look like in a valuation sense? And even at this price, we can get valuations much higher. Now, that's, as I said, because you have to move away from a really strict, a pinpoint estimate of the growth you're assuming in your valuation, because it's actually slightly less orthodox, if you like. That just means we'll own less of them, and it's the same with Altium. And frankly, it's the same with Netwealth and Hub. We don't look at it and say we think this should trade on 24 times next year. We look at it and say if they can get to 5 to 10% market share over the next 5 to 10 years, can you see the share price doubling or tripling or more? And we can. But because the risks are high, we'll keep the weight reasonably low.
Fantastic. This is a stock-specific one. Have you changed your view on Vocus recently?
It depends when you start. So Vocus, we had a big holding in for about 10 years, and then we sold when they merged with M2. That was about 2 or 3 years ago. We bought back in about 9 months ago, and on the basis that the share price had completely cratered. So thankfully we did get out before it fell, but it fell below a reasonable valuation in our mind. Also, there are catalysts now that could see earnings grow reasonably well. Firstly, just another layer on the valuations. It was largely assumed that this company was way overgeared and needed to either sell assets or raise equity. That's why the share price fell so much. But we did that work on the balance sheet and realised that they are actually not that likely to need to raise equity or sell assets at the wrong time. And then the business itself, it's got a new management team. They're hell-bent on... so what it is, it's a collection of about 15 businesses put together. And not quite bolted together properly. So there's a lot of duplication in costs and platforms, and the new management team, that's what they're doing. They're fixing it. And if they fix it properly, then there's a hell of a lot of earnings upside there. And equally, there's one other layer. These guys, so Vocus and the other providers of NBN have everyone's kind of now aware that the NBNs did overpromise and underdeliver, and equally the resellers like Vocus and Telstra and TPG have just been caned because there's no margin in it. There's a sense that you get a bit of a free option here. I suspect, and we don't gamble on this, but it is a free option. I suspect that if the Labor government if a Labor government is formed, then they'll write the NBN down, and if you write the NBN down, they can drop their prices because they don't have to. Their prices are way too high, and if they've dropped their prices, that's really, really good for the reseller sector, which is Vocus. So you're not paying for that now. We're not pricing it in. It's a free option.
Fantastic. Just a question on China's come through. So do you have a view on changing Chinese regulations and the potential effect on the likes of Bellamy's, A2 and Blackmore's?
Yes, we do, and that is that no one can have a firm view on what is going to happen. So we've been to China twice to discover as much as we can as to how much you can know about regulatory risk in China. And we've spoken to people that have lived there for 20 years, and even they are shocked at some of the directional change in regulatory activity in China, and that's why things like Bellamy's and A2 and Blackmore's for us are too risky. It's a communist country with it is particularly unpredictable, and the bureaucratic processes and the motivations are not predictable. So anything you see in the trading activity of Bellamy's and A2 and Blackmore's today could change dramatically with no notice on factors that you can't understand fully. So it's not the sort of, it's not bankable in our view.
Okay. What is the investment thesis behind Jumbo Interactive? Can you just give me a couple of details on that, please?
Yep, absolutely. So Jumbo Interactive is the largest reseller of lotto tickets in Australia, and it's online. So about 1 in 5 tickets in lotto is sold online in Australia today, and it was kind of 10% 5 years ago. Now, over the next 5 years, so it's growing very quickly, and it's just it's a natural shift, as you can imagine. It's like the newspapers went out of business, or going out of business because of realestate.com.au and things like that. We would assume, and these guys are the monopoly provider. So Tats sells it on their own online, and they use Jumbo Interactive, and they own 15% of it. So we would assume, not without risk, but we would assume over the next 5 years that it goes from 1 in 5 to probably 2 or 3 in 5. It's probably going to be 60%, and ultimately I don't think anyone will buy a Tats ticket in a newsagent again at some point. But we'll wait and see. But the point is, if it's only 1 in 5 and it goes to 2 in 5 or 3 in 5, then this market, for them can double and triple. And but as I said, it's not without risk. I put it back in that camp of Pro Medicus, Altium, the platform stocks, companies that grow this quickly, and it's delivered a huge return for us. But companies that grow this quickly are volatile, and you can't bank every last detail of the financials. So we keep the weight at about 1% of the portfolio accordingly.
Great. How is the Royal Commission impacting the stock picking environment, I guess, a bit more broadly away from the stocks you mentioned earlier?
Well, that's the primary one. Anything with a risk of being regulated out or having a conflict highlighted. So that's things like IOOF, and there's financial services stocks that we think are riddled with that kind of conflicted risk. They're there to be, for us, you just wait and see, because there's still going to be political reactions to this, and it hasn't played through yet. And then on the, and equally on the novated lease side of things, that I don't think that'll be heavily regulated, but you can never tell. As I said, Hayne originally struck the mortgage broking industry out of business pretty well without much warning. So that's not 100% guaranteed to be left alone. Hence, we've sold down pretty aggressively in those stocks. But then there are businesses that are well positioned to pick up to benefit from the Royal Commission. Equity Trustees is one, and I would say Pinnacle Investments is another one. They're a collection of boutique fund managers, and if you think there's a lot of funds being managed by some of the brand name bank fund managers, which there's a conflict now that's been highlighted. So will people sort of shift their funds from there into the boutique sector? I think they will. And then lastly, the platform operators, they are the single biggest beneficiaries of the Royal Commission because they are genuinely independent and there's no sense, even the perception of conflict isn't there. So that's what they're enjoying.
Fantastic. The last question we have on the line, what sector are you most excited about right now in your universe?
I'd say the platform sector.
Nice and easy. Well, happy to leave it there. Thank you, Ed, and thank you everyone on the line for joining us today and for all your questions. I hope you found today's session of value to yourself and obviously for communication to your clients. We'll send through the presentation and the recording next week. But in the interim, please feel free to reach out to your local BDM. Their contact details are on the website if you have any further questions. So all the best. Thank you very much.
Thanks for your time.